Let's start with a review of TRID foundations and purpose. What is TRID and why it matters? What is the primary purpose of the TILA-RESPA integrated disclosures? Is it A, to simplify and consolidate disclosure forms for better consumer understanding? B, to increase the number of forms required in mortgage transactions? C, to eliminate the need for disclosures in mortgage transactions? Or D, to provide lenders with more control over the disclosure process? The answer is A, to simplify and consolidate disclosure forms for better consumer understanding. TRID aims to simplify and consolidate the disclosure forms required in mortgage transactions to help consumers understand their loan terms and costs. A borrower is reviewing their loan estimate under TRID. What key benefit does this document provide to the borrower? Is it A, it guarantees the loan approval? B, it provides a clear understanding of loan features and costs? C, it replaces the need for a closing disclosure? Or D, it eliminates the need for further documentation? The answer is B, it provides a clear understanding of loan features and costs. The loan estimate helps borrowers understand the key features, costs, and risks of the mortgage loan they are applying for.
Have you noticed the code in the bottom corner? Next time you're stumped, take that code to birdsy.ai for immediate help and a free study session with Birdsy, your personal AI study partner. Plus, you'll get access to hundreds of additional questions, helping you move closer to passing your exam with confidence. The next time you're feeling unsure or stuck, give it a try.
How does TRID impact the timing of mortgage disclosures? Is it A, it allows disclosures to be given at any time before closing? B, it eliminates the need for timing requirements? C, it requires disclosures to be given only after closing? Or D, it mandates specific timing for when disclosures must be provided? The answer is D. It mandates specific timing for when disclosures must be provided. Why this question may seem a bit tricky. TRID introduces specific timing requirements for disclosures, which can be confused with other regulations. Which transactions are covered/which are exempt? Which type of transaction is covered under the TRID rule? Is it A, closed-end consumer credit transactions secured by real property? B, open-end home equity lines of credit? C, reverse mortgages? Or D, loans secured by vacant land? The answer is A, closed-end consumer credit transactions secured by real property. TRID covers most closed-end consumer credit transactions secured by real property, including purchase and refinance loans. A borrower is applying for a loan to purchase a vacation home. Is this transaction covered by TRID? Is it A, no, because it is not a primary residence? B, yes, because it is a closed-end consumer credit transaction? C, no, because vacation homes are exempt? Or D, yes, because all real estate transactions are covered? The answer is B, yes, because it's a closed-end consumer credit transaction. TRID applies to most closed-end consumer credit transactions secured by real property, including loans for vacation homes. Which of the following transactions is exempt from TRID requirements? Is it A, purchase of a primary residence? B, refinance of a secondary home? C, reverse mortgage? Or D, loan for a new construction home? The answer is C, reverse mortgage. Why this question may seem a bit tricky. It involves knowing specific exemptions, such as reverse mortgages, which are not covered by TRID. Loan estimate essentials. Timing, when to issue the loan estimate, and application triggers. When must a lender issue a loan estimate after receiving a complete application? Is it A, 1 business day? B, 3 business days? C. 5 business days. Or D. 7 business days. The answer is B. 3 business days. A lender must issue a loan estimate within 3 business days after receiving a complete application to comply with TRID rules. What is considered a complete application under TRID rules? Is it A. Name, income, social security number, property address, estimated property value, loan amount? B. Name, income, credit score, property address, estimated property value, loan amount? C. Name, income, social security number, property address, estimated property value, credit score? Or D. Name, income, social security number, property address, loan amount, credit score? The answer is A. Name, income, social security number, property address, estimated property value, loan amount. A complete application includes 6 key pieces of information: consumer's name, income, social security number, property address, estimated property value, and loan amount. A borrower submits an application on a Friday. When is the latest the lender can issue the loan estimate if Monday is a holiday? Is it A. Monday, B. Tuesday, C. Wednesday, or D. Thursday? The answer is C. Wednesday. The lender must issue the loan estimate by the 3rd business day, which would be the following Wednesday, considering Monday is a holiday. If a borrower provides all required information except the property address, is the application considered complete under TRID? Is it A. Yes, because the lender can estimate the address. B. Yes, if the lender has enough information to proceed. C. Yes, if the borrower intends to provide it later. Or D. No, because the property address is missing. The answer is D. No, because the property address is missing. Why this question may seem a bit tricky. The property address is one of the 6 required items for a complete application. Without it, the application is incomplete.
If you're finding this helpful, please take a minute to like this video and subscribe to our channel for more practice exams, useful tips, and complimentary study sessions with Birdsy.
Required content, disclosures, tables, costs, and good faith rules. What is the purpose of the loan estimate form in the mortgage process? Is it A. To provide borrowers with estimated loan costs and terms? B. To finalize the loan agreement between lender and borrower? C. To replace the closing disclosure form? Or D. To offer a guarantee of loan approval? The answer is A. To provide borrowers with estimated loan costs and terms. A loan estimate form provides borrowers with important details about their mortgage loan, including estimated interest rates, monthly payments, and closing costs, helping them make informed decisions. Which section of the loan estimate details the estimated closing costs? Is it A. Loan terms, B. Closing cost details, C. Projected payments, or D. Comparisons? The answer is B. Closing cost details. The closing cost details section of the loan estimate provides a breakdown of the estimated closing costs, including loan costs and other costs. What is the good faith rule in the context of the loan estimate? Is it A. Lenders must approve loans within 3 days. B. Borrowers must accept the first loan offer. C. Estimated costs should closely match actual closing costs. Or D. Lenders must provide a discount on closing costs. The answer is C. Estimated costs should closely match actual closing costs. The good faith rule requires that the costs listed on the loan estimate closely match the actual costs at closing, ensuring transparency and accuracy. A borrower receives a loan estimate with a lower interest rate than expected, What should they verify to ensure the rate is accurate? Is it A, the lender's reputation, B, the loan's term length, C, the estimated closing costs, or D, whether the interest rate is locked? The answer is D, whether the interest rate is locked. Borrowers should verify if the interest rate is locked or subject to change, as a floating rate could increase before closing, affecting the loan's cost. Why might a borrower be surprised by the final costs at closing, despite receiving a loan estimate? Is it A, the loan estimate is a binding contract, B, some costs can change within legal limits, C, the lender must cover any cost differences/stop, or D, the borrower misunderstood the loan terms? The answer is B, some costs can change within legal limits. Why this question may seem a bit tricky. Borrowers might assume the LE is final. However, certain costs can change within legal limits, leading to differences at closing. Tolerances, allowable variances, and when redisclosures are needed. What is the maximum allowable variance for charges that can increase at settlement without requiring a redisclosure of the loan estimate? Is it A, 0%, B, 10%, C, 15%, or D, 5%? The answer is B, 10%. The maximum allowable variance for charges that can increase at settlement without requiring a redisclosure is 10%. Charges exceeding this variance require a new loan estimate. Which of the following charges is subject to zero tolerance, meaning it cannot increase from the loan estimate to the closing disclosure? Is it A, origination charges, B, title services, C, recording fees, or D, homeowner's insurance? The answer is A, origination charges. Origination charges are subject to zero tolerance, meaning they cannot increase from the loan estimate to the closing disclosure. A borrower receives a loan estimate with a quoted interest rate. The rate lock expires and the rate increases. What must the lender do? Is it A, do nothing as rate changes are expected, B, inform the borrower verbally, C, issue a revised loan estimate, or D, wait until closing to disclose the new rate? The answer is C, issue a revised loan estimate. If the interest rate changes due to an expired rate lock, the lender must issue a revised loan estimate to reflect the new rate. Closing disclosure essentials. Timing when borrower must receive CD before consummation. How many business days before consummation must a borrower receive the closing disclosure? Is it A, 3 business days, B, 5 business days, C, 7 business days, or D, 1 business day? The answer is A, 3 business days. The borrower must receive the closing disclosure at least 3 business days before consummation to review the terms and costs of the loan. A borrower is scheduled to close on a home loan on Friday. By which day must they receive the closing disclosure to comply with regulations? Is it A, Monday, B, Tuesday, C, Wednesday, or D, Thursday? The answer is B, Tuesday. The borrower must receive the closing disclosure by Tuesday to ensure the 3 business day review period is met before the Friday closing. If a borrower receives the closing disclosure on a Wednesday, when is the earliest they can close on the loan? Is it A, Thursday, B, Friday, C, Saturday, or D, Monday? The answer is C, Saturday. Why this question may seem a bit tricky, it requires understanding that the 3 business day period includes the day of receipt. Thus, the earliest closing day is Saturday. required content and updates, loan costs, other costs, and summaries of transactions. What section of the closing disclosure details the costs associated with obtaining a loan, such as origination charges? Is it A, loan costs, B, other costs, C, summaries of transactions, or D, loan terms? The answer is A, loan costs. The loan costs section of the closing disclosure includes origination charges, points, and other fees related to obtaining the loan. Which section of the closing disclosure includes prepaid items like homeowners insurance and property taxes? Is it A, loan costs, B, other costs, C, summaries of transactions, or D, loan terms? The answer is B, other costs. The other costs section includes prepaid items such as homeowners insurance and property taxes. What does the summaries of transactions section of the closing disclosure provide? Is it A, a breakdown of loan costs, B, a list of prepaid items, C, a summary of financial transactions, or D, an overview of loan terms? The answer is C, a summary of financial transactions. The summaries of transactions section provides a detailed summary of the borrower's and seller's financial transactions.
If you're finding this helpful, please take a minute to like this video and subscribe to our channel for more practice exams, useful tips, and complimentary study sessions with Birdsy.
Which section of the closing disclosure might mistakenly be thought to include the total amount of cash needed to close? Is it A, loan costs, B, summaries of transactions, C, other costs, or D, loan terms? The answer is B, summaries of transactions. Why this question may seem a bit tricky, the summaries of transactions section provides a detailed financial summary, but the total cash needed to close is specifically highlighted in the cash to close section. When changes require a new 3-day waiting period or corrected CD, which change to a closing disclosure requires a new 3-day waiting period before closing? Is it A, change in loan product, B, decrease in loan amount, C, increase in property taxes, or D, change in closing date? The answer is A, change in loan product. A change in the loan product requires a new 3-day waiting period because it significantly affects the terms of the loan. A borrower receives a corrected CD showing an increase in the APR. Does this require a new 3-day waiting period? Is it A, no, it does not require a new waiting period, B, yes, it requires a new waiting period, C, only if the APR increases by more than 0.5%, or D, only if the borrower requests it? The answer is B, yes, it requires a new waiting period. An increase in the APR beyond certain limits requires a new 3-day waiting period to ensure the borrower is aware of the change. If the lender discovers a typo in the borrower's name on the CD, does this require a new 3-day waiting period? Is it A, yes, any error requires a new waiting period, B, yes, if the borrower requests it, C, no, only financial changes require it, or D, no, a typo in the name does not require it? The answer is D, no, a typo in the name does not require it. Why this question may seem a bit tricky. Typos in non-critical information like names do not require a new waiting period, unlike changes affecting loan terms. Comparing LE and CD and common pitfalls. Comparing terms, what must match? When comparing the loan estimate and closing disclosure, which of the following terms must match exactly? Is it A, APR, B, down payment, C. Property taxes, or D. Homeowners insurance? The answer is A. APR. The APR must match between the LE and CD as it reflects the total cost of the loan, including interest and fees, ensuring transparency for the borrower. A borrower notices a discrepancy in the loan amount between their loan estimate and closing disclosure. What should they verify to ensure accuracy? Is it A. Interest rate, B. Closing costs, C. Monthly payment, or D. Loan amount? The answer is D. Loan amount. The loan amount must match between the LE and CD to ensure the borrower is receiving the agreed-upon loan terms. Which term is often mistakenly thought to need exact matching between the loan estimate and closing disclosure, but actually does not? Is it A. APR, B. Loan amount, C. Estimated taxes and insurance, or D. Origination charges? The answer is C. Estimated taxes and insurance. Why this question may seem a bit tricky, many assume that all costs must match exactly, but only specific terms like APR and loan amount require exact matching. Pitfalls: late disclosures, excessive variance, missing items. What is a common pitfall when comparing loan estimates and closing disclosures that can lead to compliance issues? Is it A. Late disclosures, B. Early disclosures, C. Consistent disclosures, or D. Excessive disclosures? The answer is A. Late disclosures. Late disclosures can lead to compliance issues as they may not provide the borrower sufficient time to review and understand the terms. Which issue arises when there is excessive variance between the loan estimate and the closing disclosure? Is it A. Improve borrower understanding, B. Borrower confusion, C. Increased lender profits, or D. Reduced compliance checks? The answer is B. Borrower confusion. Excessive variance can lead to borrower confusion and potential regulatory scrutiny, as it may indicate inaccuracies or changes in loan terms. A borrower notices that certain fees disclosed in the loan estimate are missing from the closing disclosure. What issue does this represent? Is it A. Timely disclosure, B. Excessive variance, C. Missing items, or D. Accurate disclosure? The answer is C. Missing items. Missing items between the LE and CD can lead to non-compliance and borrower dissatisfaction, as all fees should be consistently disclosed. Practical rules, exceptions, and enforcement. Intent to proceed, waiving waiting periods, and change circumstances. What is required for a consumer to provide an intent to proceed with a loan application under TRID rules? Is it A. A signed document, B. Verbal, written, or electronic communication, C. Payment of a fee, or D. Submission of additional documents? The answer is B. Verbal, written, or electronic communication. The consumer must communicate their intent to proceed with the transaction after receiving the loan estimate. This can be done verbally, in writing, or electronically. Under what condition can the waiting period for the closing disclosure be waived? Is it A. If the borrower requests it, B. If the lender agrees, C. In case of a bona fide personal financial emergency, or D. If the loan amount is below a certain threshold? The answer is C. In case of a bona fide personal financial emergency. The waiting period can be waived if there is a bona fide personal financial emergency, such as an imminent foreclosure. A borrower receives a loan estimate and later requests a change in the loan amount. How does this affect the loan estimate under TRID rules? Is it A. The original loan estimate remains valid, B. The loan application must be restarted. C. The borrower must provide a new intent to proceed. Or D. A revised loan estimate must be issued. The answer is D. A revised loan estimate must be issued. A change in loan amount is considered a changed circumstance, requiring a revised loan estimate to be issued. Record keeping, penalties, and enforcement by CFPB. What is the primary purpose of record-keeping requirements under TRID rules? Is it A, to increase administrative workload, B, to ensure compliance and transparency, C, to reduce costs for lenders, or D, to provide marketing data? The answer is B, to ensure compliance and transparency. Record-keeping ensures that lenders maintain accurate records of disclosures and transactions, facilitating compliance checks and audits by the CFPB. How long must lenders retain records of TRID disclosures? Is it A, 1 year, B, 3 years, C, 5 years, or D, 10 years? The answer is C, 5 years. Lenders are required to retain records of TRID disclosures for 5 years to ensure compliance and facilitate audits. A lender fails to provide a borrower with the closing disclosure 3 days before closing. What consequence might the lender face? Is it A, penalties from the CFPB, B, a delay in the loan process, C, a requirement to reissue the loan estimate, or D, no consequence if the borrower agrees? The answer is A, penalties from the CFPB. Failing to provide the closing disclosure on time can result in penalties from the CFPB as it violates TRID rules.
Thanks for joining us today. If you found this video helpful, subscribe to our channel for more practice exams, tips, and tricks. And don't forget to visit Birdsy.ai for complimentary study sessions with Birdsy, your AI-powered study partner.